Well, joining us now is Yingyan Cheng from Coolabah Capital. Yingyan, good to see you.
Good to see you, Peter. Thanks for having me on.
Right. Now, you are the lady we go to when we try to understand the bond market, the implications for interest rates, because that's the only reason we're interested in the bond market. Interest rates affect our loans, it affects our business, it affects our savings. So we're interested. China and the Evergrande property company that's blown up. Is there an implication in that story for interest rates?
Yeah, I mean, sort of a good question. I mean, if we sort of go back to the whole sort of what it means, Evergrande, look, I think just given the news flow that came out over the course of recent sort of weeks, it looks like the equity markets and broader markets have sort of shrugged off Evergrande. I think people have sort of come to the realization that it will still be very much sort of contained to China, with most of the investors being, Asian sort of high yield investors. Obviously, there are, global funds that invest in Evergrande, but, in terms of the majority, it isn't. And so, what people sort of thought, is this the Lehman sort of moment for China, thus far hasn't really sort of necessarily played out, because, it still feels very much contained. And, with the Evergrande sort of issues, they already had issues, since last year, since previous years as well. So that sort of unraveling, you could say, was a bit sort of inevitable. Obviously, I'm not an Asian high yield specialist, so I can't really sort of foresee, other central banks, whether it's the US Federal Reserve or the Reserve Bank of Australia, really, looking at that and saying, hey, that's going to affect our economy as such. And, as a result, we don't sort of think that there'll be any sort of easing that takes place in response to that.
Yeah. And the bottom line is, if you thought this was going to be a big international financial system problem, given the nature of Coolabah, you would be right onto it, because it has implications on yields and the bonds you're invested in. So, okay, if you're comfortable, we're comfortable. Let's go to the question. Do you believe interest rates are on hold to 2024 here in Australia? I know I ask this question all the time, but one day you're going to change. They're going to say, hey, you've changed your view on this.
Yeah, look, our view has been that the RBA could raise rates late 2023 to early sort of 2024. And, in terms of what the RBA, in terms of their rhetoric, has been sort of signaling, more like 2024. That's because we find ourselves in a very sort of different situation to offshore central banks. Look, definitely, with the sort of hawkish overtones from overseas, there is the risk that, the RBA could hike sooner. However, the RBA is facing a very different sort of a situation to other global central banks. We're starting to see, signs of inflation definitely in the US. We're seeing signs of inflation in parts of Europe. Definitely even just our neighbours, New Zealand, for example. The problem with the RBA is that even before the pandemic, we were, undershooting our inflation and employment objectives. And so then we got hit with the pandemic. So as a starting sort of a base as such, the RBA feels like it is behind, and therefore they're going to be much more stimulatory, if anything, compared to, say, the RBNZ, for example, who is likely to hike rates soon as a result.
Okay. Let's move to the next related issue. If the US finds it's growing, so by the middle of next year or even earlier, that stronger than what was expected, there is a feeling, well, I believe they could raise interest rates at least by the middle of 2022. Correct me if you totally disagree. But if they did, would that put pressure on us eventually to follow?
Yeah, good question, Peter. And look, it's not inconceivable that they could, hike rates in the US as early as mid next year. Obviously, they've signaled that they are likely to start tapering at the end of this year. And just from, the Fed speak, it does seem that they want to get this tapering done, in a fairly quick fashion as well. And typically tapering is a separate thing to interest rate hikes. However, this could follow quite soon. In terms of, the RBA following the US in lockstep, that has traditionally been the case. However, there is a possibility that, monetary policy does deviate, and we have seen that since. So it wouldn't be unsurprising to me that the RBA sticks to its own its own objectives in terms of what's happening on the ground here with respect to inflation and employment. But, obviously that's not to say when we open up the economy again, as in when we come out of lockdown and we have, spurts of economic activity, there's nothing to say that, the risk there is that those rate hikes get brought forward and that tapering also gets brought forward as well.
That's my final question, Ying, is that if Australia's economy does really rocket along faster than what the RBA thinks, and we're starting to see the inflation goals come along faster than what the RBA thinks, would that then put pressure on them to change their outlook on interest rates and when they rise?
Yeah, it's a bit of a complicated issue for the RBA because on the one hand they're watching wage inflation. So as there's a key sort of barometer, they're watching wage inflation quite carefully. The issue is that they would want to see very consistent, ongoing inflation in order for them to sort of move towards that, rate hiking or that tightening sort of a schedule. And we've spoken about this before, and that's the key thing around, non-resident workers. So as, we got hit with the pandemic and non-resident workers moved back to their home countries and they left Australia, their jobs needed to be filled, and these jobs were filled by Australians. That had the effect of, increasing employment and putting downwards pressure on our unemployment rate. Now, the key sort of consideration then would be, well, when we do eventually open up our borders, which is slated to be next year, for example, then that would have the opposite effect as these non-resident workers come back to Australia. So if anything, that would take away pressure from wage inflation. It would be slightly deflationary, if anything. So, perhaps, again, that inflation sort of problem is not something that we face until, a couple of years down the track for Australia.
Okay, so the headline out of your answer is foreign workers keep interest rates low. Love foreign workers.
Well, I mean, obviously we don't want to sound xenophobic at all. But yeah, look, it's just the way that the jobs data is classified here. So jobs held by non-resident workers are not included in the employment numbers here.
Oh, okay, great. All right, Ying, thanks for joining us.
Thank you so much, Peter.